Well, it's good to be here so early on a Saturday morning. Many of you are retired, some are thinking about retiring. Just for me to get a feel, can you tell me who here is already retired? Okay, a good number. And how many of you then are anticipating retirement? Okay, a couple more. Okay, so my plan today is to cover a little bit of both, the preparing for retirement, but also how do we get not just to retirement, but through retirement. And through retirement with the kind of confidence that you're having the lifestyle that you really want and envision. That's kind of the goal today. So that's what we're going to spend the first part on, is we're talking about retirement income planning. When we stop working, how do we then generate money to continue the lifestyle that we want? So we'll do that in the beginning, and then my plan is, we just did a 2020 outlook for our clients and some of their guests. So I'm going to touch on some of the key parts of the economy going forward, recapping maybe a little bit about the economy that's happened, and really looking at what does that mean for investors going forward today. Then the third little part is I was going to spend some time talking about the Secure Retirement Act. And that's a law that just got passed through really at the end of last year pretty quickly. And it does affect IRAs, required minimum distributions, among many other things. So we'll just touch on a couple of those key ones that I think affect you guys the most, the ones that are in or near retirement. Basic questions. When we're looking at retirement, these are the three things that I ask my clients. What does retirement mean to you? Because it's not the same, you know, I'm going to sit on my porch, my rocking chair, drink some lemonade, you know, watch the grandkids run around. It's different for everyone. So what does your retirement look like? How much do you want to travel? How much do you want to not travel? How much do you want to spend on improving your house? How much do you want to spend on a new hobby? Do you want to work part-time, volunteer? You know, one of the things that I've found working with a lot of retirees is that they say, I'm busier in retirement than I was when I was working. And so that's a good thing. So what we've got to figure out is, what does that busy mean, and how much, I mean, basically, how much is that going to cost? Okay? When do you plan to retire, and how long will your retirement last? So one of my clients came up to me the other day and he said, Danielle, I've been retired exactly 30 years now. My working career was 30 years. I have spent as much time in retirement as I did working. And that's an interesting thought. You know, depending on life expectancies and kind of, you know, family histories, there's a good chance that many of us could be living into our 90s or 100. And if we're retiring at 58, 60, 62, 65, we're talking a 30-year retirement. On average, I would say 20 years. But some of it can be 30 years. We actually have now 2 clients. We had one. We have 2 clients that are over 100. Yeah. And I think that number is going to keep growing. So those are key questions that you want to ask yourself about your retirement. Retiring early, a few things to think about: fewer years to accumulate, a longer distribution period, and then also an impact on Social Security. Now, the impact on Social Security is usually not as big for men as it is for women. And what I mean by that is most men work a full career. They take very little time off. A lot of women will take time off to raise kids, and that negatively impacts their Social Security. Okay? Social Security, when to take it and how to take it, is one of the most important decisions that you will make. And there's different ways that you can look at that. Also, health care. How, until you reach 65, are you going to pay for health care? Does work cover part of it? Is it all out of pocket? So we need to look at those things too if we retire earlier. If you delay retirement, you've got a couple benefits. More accumulation years and a shorter distribution period. You can positively impact Social Security. You can possibly reduce your health care costs. But what also happens if you delay retirement? You maybe don't get to enjoy things as much as you wanted to. You're older, you're not as fit, maybe you don't have as many travel years in you anymore. So there's those balances of when to retire, either earlier or later. And then a lot of my clients, what they do is they'll retire from their, what they call their main job, and then sometimes just do some consulting work or some part-time work. We have many clients. I have a client that works at Home Depot. We have clients that are doctors that do some consulting work. So really figuring out what that looks like, and it really can help reduce the demand on your personal savings. If you get a little bit of part-time work, sometimes there's potential to look at healthcare, and again, it can help your Social Security. The non-financial benefits of working a little bit in retirement, it really keeps you sharp. It keeps you knowing what's going on in the world. So maybe looking at that. Phased out retirement programs is what we call it. All right, so how long will retirement last? We just talked about that. Average 65-year-old can expect to live another 20 years, so we're looking on average 20 to 30 years. Life expectancy has continued to increase. All right, so when we look at a retirement plan, there's three main pieces that we're trying to balance. If you really think about it, we're trying to figure out how can we maximize our ability to enjoy retirement? How can we manage the risk of outliving our money? And manage the risk of unexpected life events. So I always tell people, my job would be easy if we were like milk cartons and we had an expiration date here and I go, okay, we got to plan till 82, we're good. But I don't know if we need to plan till 82 or 85 or 87 or even, like I said, 100. The other thing that would be easy is we knew what was going to happen. We've got this health issue and this health issue, and so we can plan for that. But a lot of times we don't know, so we keep this money for just in case. So we have to plan for those unexpected health or life events. Spending too much, spending too little. Okay? So my job, I tell people, is just as much to grow your money and help you spend your money, or my job is to grow your money as to also help you spend your money. And what I mean by that is sometimes we've saved and we saved and we saved and we're such good savers that we don't really know how to turn around and spend. And every time we spend, it's with hesitation of, am I spending too little? Am I spending too much? And that's where I think that confidence comes in, when you really know you have a good spending plan in place. All right, so let's take a look at our process. There's a couple of ways to describe this. One of the best ways I describe it is with our GPS, more and more common. How many of you have used GPS to get somewhere, especially somewhere you don't know where you're going? How many of you can't go anywhere without a GPS? A few of us. It's like we get so tuned into the GPS that we can't live without it. Retirement planning is sort of like that. So for GPS, what you've got to figure out is, where are you starting from? Where are you today? Where are you trying to go? And then the GPS will tell you the best way to get there. And if a road is closed or something happens, it reroutes you. There's an alternate plan. So that's what we're looking at, is where are we today? Where are we trying to get to? And how do we get there? One of the questions that people will ask me also is, can I get there? So the example I give of that is, if we're trying to go to San Diego, but we've got to be there in 45 minutes, we can't do that. So that's the big question too, is can we get there? Can I retire, Danielle? Okay? So a couple of pieces, we want to look at how much income you're going to need in retirement, and we're going to go through all of these more in depth. We're going to look at major factors. The two biggest factors that I tell people you need to be aware of are taxes and inflation. And I will tell you, if you leave this class today and you don't remember a single thing that I've said, remember that. You will be impacted by taxes and inflation more than you realize. I always tell people it's like the little devils on your shoulder, taxes and inflation, taxes and inflation. You've got to stay ahead of them. Inflation is like the Mack truck on the freeway. It's right behind you. What happens, especially with inflation being what we call tame right now, it's a little bit more than 2% on average. People think it's not that big of a deal. But let me just tell you, if you gain 2 pounds a year, We know where this is going, right? You gain 2 pounds a year in retirement. All of a sudden, you're 60 pounds heavier. Where did that come from? That's what inflation is. Okay? All right, so let's look at the first step. How much income are we going to need? How do we figure that out? So here's what we call a rule of thumb. The rule of thumb is that we'll need between 60 to 90% of our pre-retirement income. What do we say about rules of thumb? I'm not a big fan of rule of thumb. You can read this in a book. I'm not going to add much value if we just stick with the rule of thumb. So if you know nothing, 60 to 90% can work. But really it boils down to, what does your retirement look like? Because I have people that spend more. They spend more in retirement than what they made when they were working. And I have people that spend significantly less. So rule of thumb, 60 to 90, but really it's unique to you to figuring out what your retirement looks like. Okay? Think about what expenses will change. So the way we look at expenses, and I usually use the whiteboard, so I don't know if you guys can see over there. But I have people break their expenses down into 2 key categories: your needs and your wants. And there's a reason for this. So if we're saying 60 to 90%, let's say that we come up with 50,000. 50,000 is what we want to have in retirement. How much of that is a need and how much of is that a want? So let me give you an example of like food. Some food is a need. But if you want to dine out 5 times a week, that's more of a want. So does that make sense? We want to have needs and wants broken out. Then we want to look at what's going to change, what will decrease, which will stop, and which will increase. You following me? So like a mortgage. Many times people say, I want to have my house paid off before I retire. That's great if that's your goal. Not everybody can or should do that. Sometimes mortgages will finish 10 years into retirement. Sometimes there's people that they never finish their mortgage. That's all individual. So that's what we want to look at. Is that mortgage fixed and when's it going to end? What expenses will go down? Maybe transportation goes down because you're not commuting anymore. What expenses go up? I can tell you definitely what expenses go up. Medical. And medical goes up in more ways than people think. So one of the biggest things that I always tell people to look at is quality of life. And what does it take to keep your quality of life? If you can't eat because your teeth, you need new dentures or you need new implants, that's not covered. And that's expensive. I'll tell you, dental is probably the biggest health expense that people did not expect in retirement. Any other thing that keeps your quality of life that may not be covered by medical? Think about that. Then you've got your medical. You got your co-pays, your premiums, and so forth. So healthcare expenses really need to be looked at in there, and we haven't even gotten into long-term care types of costs. We'll do that later. Also look at special retirement pursuits. So like, for example, one of my clients, he wanted to go into woodworking. So he bought equipment, bought the wood, and now is making furniture. And he's now making some money from it. But think about if you want to do anything like big travel, hobbies, and list them out. And when you list them out, needs, wants, and a range. So ideally, if we have 50,000, we'll say, okay, Danielle, out of that, 40,000 is a need. That covers my basics. But the extra 10,000 is because I want to travel a little and do a little bit more fun things. So 40,000 is minimum, 50,000 is ideal. Okay? All right. Healthcare costs, Medicare comes in at 65, prescription drugs. There's policies to cover gaps. I'm not going to spend too much time on this. The main thing is Medicare will not pay for chronic long-term care. They pay for you to rehab, but they don't pay for chronic long-term care. So how are we going to account for that cost of long-term care? I always tell people there's a couple of options. You can pay out of pocket, okay? And so we have a client right now that had a stroke, and she is paying out of pocket. And it's $15,000 a month right now to get her care for that, and she's in her 60s. So it's not like it's that old either. So you can pay out of pocket. So that's one of the things you can stress test your portfolio to see if I were to need long-term care for 5 years, can my portfolio withhold that? Or 7 years, or 10 years? You know, one of the things about dementia is a lot of times the physical body is all good, the mind isn't there. You can live a long time with dementia and needing care. So paying out of pocket, you can get long-term care insurance. So here's the pros and cons of long-term care insurance, and I'll kind of shorten it up. Way back in the 70s is when long-term care insurance started coming out. You could purchase policies. GE was one of the biggest long-term care providers of insurance at that point. What they didn't realize is that people lived longer and longer lives. In general, the insurance industry did not price long-term care insurance appropriately. So fast forward, and the companies that are providing long-term care insurance, what do they have to do? If they are paying out more than they think they were going to be paying out, they do what? Raise premiums. So PERS was a big one on that, where here, you can cut your benefits or we're going to raise your premium. Those are your choices. So a lot of the companies had to reprice. They had to apply to reprice, and they did. And your choice was either keep it and keep something or pay more. There used to be even what we called unlimited long-term care policies. They don't exist anymore because nobody wants that unlimited liability as an insurance company. Then they evolved into different types of products. One of the best products I think today is what's called a hybrid product, and it's a life insurance product. So there's two types of long-term care insurance. There's what we call the traditional pay-as-you-go. You pay a premium at the end of the year. If you didn't need long-term care, you were covered, but that money's basically down the toilet. At some point, if you die and you never need long-term care, the insurance company keeps all the money and premiums that you've paid through the years. That's the traditional. It's just like your house insurance, just like your car insurance. I tell people, you don't buy long-term care insurance with the hope of using it. Just like you don't drive around in a car hoping you get in an accident. So, boy, I can now use my auto insurance that I've been paying on for years. It's pure protection, okay? It's expensive, right? Yeah. People say, oh, Danielle, long-term care insurance is expensive. Yes, it is. Why do you think it's so expensive? Because it's used. If you look at insurances, it's all about risk. So there's this insurance, it's called accidental death and dismemberment insurance. Many people get it when they're employed. It costs maybe $1 or $2 out of your paycheck. Why do you think it's so cheap? Because very few people die from accidental death and dismemberment, so they very rarely have to pay out. So that's all insurance is. The more the premium, the more risk it is of paying out, okay? So you have a choice. You can either self-insure, pay out of pocket, or you can look at one of the products. Now, both insurances, no matter what you're looking at, you need to be healthy when you get it, okay? You can't get in a car accident and then call the car company, oh, I'm not insured. Can you insure me? Too late. The problem is when you're healthy, you don't want to buy it. Oh, that's a lot of money, Danielle. You know, so those are trade-offs to think about. So the pay-as-you-go, we talked about, the traditional, and then the life insurance. So the life insurance is nice. There's a little bit of a difference. Basically, one of three things is going to happen. You either can quit the policy and you get dollar for dollar whatever you put out back. There's a little bit of a taxation issue there because you were covered, but I'm not going to get into that. But basically, you put $100,000 in, you get $100,000 out. You live and need long-term care, and it gives you a bucket of money that you can use for long-term care. Or you die and you don't need long-term care and it gives you a small little death benefit. The death benefit is small. It's not meant to create a big death benefit. But some people like that one a little bit better because, well, at least if I didn't use it, something goes to my kids. Okay? But no matter which way you choose, all of them you have to be healthy and all of them cost money. The life insurance policy is more of a lump sum one. So that's where people take, okay, this is my $200,000 that's in cash right now. That's my emergency long-term care money that if I were to self-insure, I would use, and they use that for the policy. But not everybody has a lump of sum money that they can use for it. So it just depends. All right, so long-term care is definitely one of the biggest issues on portfolios as people get older. Other things to look for is inflation, like I said, and taxes, and then risk. There's many risks in retirement. The one most people think about is market risk, right? I retired, I have $1 million in my 401k, and then I retired in 2008, and my 401k is a 201k. Bad joke. But you know what I mean. It went down by half. It's scary. Let me tell you, I've been there with people. It is scary. So that market risk when you retire. So one of the questions that I get a lot from people is, Danielle, how do I make sure that I can still get money in retirement if my account goes down? Do annuities play a role? We're going to talk about annuities in a little bit. They may or may not play a role. One of the things about the Secure Act that we'll talk about later is they're now allowing annuities inside of 401ks because the government's worried about market risk for people. So we'll talk about that. So 3 things: inflation, taxes, and then market risks. So let's look at inflation. So this assumes a 3% inflation. Like I said, inflation's been about 2%. But even so, if something costs $50,000 today, so if we have that $50,000 in retirement, and we're going to be retired in 20 to 25 years, it's basically going to take twice as much to have that same quality of life. Does that make sense? Because people forget that. They'll say, like, I have $1 million, I need to spend $50,000 a year, so I'm good for 20 years. It's not that easy. It's not that simple. We've got to make sure that our money is keeping ahead of inflation so that we have the same quality of life. We have the same purchasing power. So we forget about inflation. But let me ask you guys, how many of you guys bought a car in the 70s somewhere? Remember buying a car in the 70s? What did the car cost? $2,000. $2,000.
And it was a brand new model.
Yep. I remember my parents bought a car. It was an avocado green Dodge Dart Swinger with a white vinyl top, brand new, and it was $3,500. And my mom had a heart attack. Imagine if she's like, an average car today, people buy cars all the time in retirement. I said, what kind of car you think about? Oh, something basic, probably about $25,000, maybe $30,000. Yeah, yeah. So inflation is real. All right. Taxes. There are all sorts of taxes that we need to worry about. So we work, we make a wage, we pay taxes, right? Then we invest what's left and we earn some more, either interest or dividends, and we pay taxes. Then at some point we die and we still pay taxes. So taxes are an issue. So we look at different ways that income is taxed. There's what we call ordinary income. That's like what we call wage income. So if you get a CD at the bank, that's taxed as ordinary income, that interest. But here's what I find happens with people is they compartmentalize money. So let's assume we have a $100,000 CD and it's earning 2%. We got a 2% CD. In a year, what is your account? This is easy math, you guys. 102,000. And then let's say you got another 2% the next year on that 1-year CD, and in another year it's now what? 104,000 and some change because of compounding. Okay? So does that CD statement ever go down? No. Because usually what happens is you still owe money, you owe tax on that $4,000, $2,000 from the year before and $2,000 from this year, but usually you pay it from another bucket of money. So you don't really think that it's being taxed. But basically, if you're earning 2%, 2 steps up, and then you've got to pay the taxes half a step back or more, and then, ooh, you got to account for inflation, because remember that 104,000 doesn't really have the same purchasing power. You take a little step back, and you're maybe what I call treading water or a little bit ahead. And that's okay, because CDs are not meant to grow your money. They're not meant to grow your money. They're there to preserve, okay? So ordinary income, and then there's capital gains and dividends. So capital gains is when you buy an investment, you hold it for a year and a day, and then you sell it and you've made money. You pay gains, you pay tax on that gain only. So if you put 10,000 in something and it's worth 12,000, you would pay tax on that 2,000, and it's at capital gains rates. Capital gains rates are always better than ordinary income. You pull money out of a 401k, which way is that money taxed? Ordinary income. Because basically all a 401k is deferred wages. You took part of your wages from your working career and pushed them out till later. So you pay ordinary income. So dividends, capital gains are taxed advantageously at 20%. Then there's the best income of all. Which one's that? Tax-free. You love the tax-free. We're going to talk about Roths because that comes into play with the Secure Act too. But there's your traditional IRAs, and then there's your Roth IRAs. The Roth IRAs, I tell people, think of it like a cookie jar. You put your favorite cookies in there. Over the years, they magically multiply. And then when you retire, you can eat all those cookies calorie-free. It's like, who doesn't want that cookie jar? So all the different types of taxes we have to take into account. One of the things that I think people underestimate, oh, when I'm in retirement, I'm going to be in a lower tax bracket. How many of you guys have heard that false statement? I hear it all the time. You know, I was told when I retired I was going to be in a lower tax bracket. I don't know who told you that, but it is the biggest myth that still gets perpetuated. Because if you're in a lower tax bracket, that means that you are worse off financially. Most of us don't plan to be worse off financially. But also, we're at the whim of whatever the Fed, the government, decides to do with taxes. So how many of you are aware that in a couple of years, that tax break that happened to businesses and individuals a few years ago will sunset and revert back? Okay? The other thing with that provision that a lot of people don't realize is it doesn't get paired up to inflation. What I mean by that is we just saw that if you're making $50,000 a year, you're in, let's say, I'm just making this up, a 24% tax bracket, okay? But we just learned that it's going to take $90,000 to keep that same quality of life. But if that $90,000 is now taxed at the 35% bracket, because the brackets are not indexed to inflation, they stay that way going forward. So not only did you need $50,000, that you now need $90,000 to have the same quality of life, you actually now need $110,000 because more of that is going to taxes. That people will actually be in higher and higher tax brackets unless they change the laws to index the tax brackets to inflation. And they do not index anymore. They did up until the 2017 Act, and that Act stopped it. So a lot of people don't realize that. And that's why they underestimate how much they're going to need in retirement. All right. Understanding risk. So I said market risk is the main thing that comes to mind, and that's definitely a risk in retirement. Imagine if you retired in the middle of 2008. I mean, there's a real risk of when you retire. Even if you retired, let's say in 2010, you still have the risk of making sure that your money lasts with the market. Then there's reinvestment risk. How many of you guys had at one point a CD that earned more than 10%? You owned a CD or a bond that earned more than 10% at one point in your life. There should be a lot of hands up here, yeah. And then if that money came due, what did you have to do? Reinvest it again. And if rates were lower, you had to get the lower rate. And you do it over and over again. So one of the stories that I share, this was back in the early 2000s, if we look at interest rates for the last 30 years, what have interest rates been doing? Coming down. People will say, like, Danielle, what about those 13% CDs of the 80s? They don't exist anymore. And if you're waiting for them, you're going to be holding your breath an awful long time. So reinvestment risk is real. Somebody came to me, they brought their mom. Her husband passed away in the 70s. He had a $100,000 life insurance policy. It was emotional money. She didn't really need it. So she went to the bank and bought a one-year CD with it. And it was over 15%. And then every year, it kept getting reinvested in a little bit less. Every year, her costs of living went up. So she was taking a little bit out of the CD over time. So she came to me when it was $90,000 and she was earning 1.7% on it. And she says, Danielle, my mom can't live off this anymore. That's reinvestment risk. Okay, so we've got to figure out ways to mitigate that. Interest rate risk. So being beholden to the government in terms of what interest rate they're paying is your interest rate risk. Also, what happens with bonds when interest rates go up? Bonds go down. So the analogy I use is if we're at like a teeter-totter, and this is your bond yield or your interest rate, and this is your principal, when interest rates go down, bond prices go up. That is why if interest rates for the last 30 years have been going down, what has people that have held bonds overall done? Very well. They've gotten a yield, an income, a coupon, and they've got price appreciation. But if interest rates go up, the principal goes down. So that's interest rate risk. We talk more about this in our Tuesday class, but again, we've got one couple hours that we're spending together. So now we've got our three-legged stool of where we get our money from. So basically, most of us, we look at either pensions, and for you guys, you might have a pension, you might not. For people that are 40 right now, the very few of them have pensions. The pension is being phased out. But we have pensions, Social Security, and then our individual savings, relying on our own savings and investments. That's really the main areas that our retirement income comes from. Some people have property, they do rental income. That's fine. That's out there. So when we do our individual retirement plans, we will look at all sources of income. Sometimes I have alimony, but alimony stops at a certain age. Sometimes we have rental income. And then I say, okay, what's the goal of the house? Do we want to always keep it as rental income, or do we want to sell it at some point? You know, so there's a lot of things, but really these three are the main ones. All right? So let's look at Social Security. I'm not going to go too much into this. There we go. Bottom line, I like that last one, is Social Security will only meet a portion of your income needs. It was never meant to be your sole income provider. When you take Social Security means a lot, especially if you're married and your spouse might be able to get spousal benefits. Delaying Social Security as long as possible in general is usually a good idea. But that's in general. Everybody's situation is different. But why do I say delaying it is usually a good idea? Because there's two main factors with Social Security. One is every year that you delay it past your retirement, full retirement age, it compounds by 8%. They give you an 8% increase. Now, I'm good, but I can't guarantee an 8% year over year increase. It's a very solid increase. The other thing that people discount way too much on Social Security is they'll look and they'll say, well, if I take it at 67, Danielle, it's $2,200 a month. But if I take it at 70, it's $2,500 a month. That's only $300. That's not that big of a deal. I would rather just get my money now than wait. We call that immediate gratification. And people will justify it, and that's fine. My job is not to judge and tell you when to take it. My job is to tell you this is what can happen if you take it early. This is what can happen if you take it later. To me, this scenario looks better, but you want your candy now, we're going to give you the candy now because you put into it your whole life and I'm going to get my Social Security back. I might die tomorrow and I want it. That's fine. Make sense? But here's what people don't look at. It's only $300, $2,200 to $2,500. But what does Social Security do? What's one of the best things? At least right now, cross your fingers, because they will change the laws so much and Social Security is going to get looked at. But what do they do right now? How many of you guys got a little Social Security raise last year? Yeah. And previous years, a little Social Security raise. So in general, let's just say if inflation is 3%, Social Security keeps up with that. It's compounding, you guys. If I take $2,500 and I earn 3% on that, and then the next year, that $2,500 plus 3%, whatever it is, earns another 3%, and the next year, so do you see what I'm saying? That even though it's a $300 gap right now, that as inflation gets added, the gap widens. And that's what people don't calculate into it. Okay? The other thing with your pensions is you want to find out if they have a COLA, cost of living adjustment. So sometimes people will come to me and they'll say, I have this pension, I didn't bring the paperwork, that's okay, tell me about it, we'll get the paperwork later. Does it have a cost of living adjustment? I think so. Okay, no, we're not gonna think, we're gonna know. You know, get the paperwork, we need to know, does it have a cost of living adjustment? The other question I ask, okay, so it's your pension, what happens if you pass away? Well, I think my husband or my wife gets 50%. Again, we think or we know. So we need to know exactly what that pension is doing, okay? No guessing. I actually taught this Saturday class and a lady came back to me. She goes, I went in my closet, I found the paperwork, I pulled it down. We don't have the 50% benefit for my wife that we thought we did. You know, so you don't just think, you need to know. Pensions. Taking a pension is one of the biggest decisions you will take. So let me give you a little story. This is one of the reasons why I'm really so passionate about educating. I take time out. My daughter, I'll be honest, my daughter has a soccer game right now. Her dad's with her, but I'm here teaching because I believe in it. Okay? My dad worked for a company for 30 years. He was in trucking. He got a pension. He retired. He didn't have a 401k. He didn't really even know what that meant to save for a 401k. He just that Social Security and pension will be all I need. So he goes to retire. He goes into the meeting. The guy says, here's your options. You can take this amount for the rest of your life, or you can take this smaller amount for you and your wife's rest of your life. My dad's a good guy. He wanted to take care of his wife, my mom. So he said, I'll take the lower one. We're not extravagant people. I remember this. I was in college. We're not extravagant people. We don't need to travel the world. That's more than enough for me and your mom. Well, my dad didn't have somebody advising him about taxes and inflation. And little by little, it wasn't the same purchasing power. He passes away. My mom's income got cut by half. Social Security got dropped. And my mom was not as well off as she thought she was. I remember when my dad was at the later stages of life, him telling me, Danielle, somebody had just took the time, just said, hey, Danny, maybe if you save some here, or maybe if you did this, just took the time to explain things to me. He goes, I would have, but I thought I was going to be okay. So that's why I teach. And that's why I'm really passionate about even teaching younger people, because I have never had anybody retire and said, you know what, Danielle, I just saved too much, too early. I really didn't need to save as much as I did, okay? All right, so pensions, we've got to understand the options. Single life, joint life, lump sum. Can there be a combo of it, okay? One of the benefits of the what we call the qualified joint survivor option is it covers for you and your wife. But then when both of you are gone, what happens to the pension? It's gone. And they are actuarials. If you don't live that long, they make more money. But if you live longer, they keep paying. The lump sum, the scary things is you've got to kind of create your own pension. But the benefit is if you pass away, hopefully there'll still be some money left to pass on. So really why I started with needs and wants is because we want to make sure those needs are covered. And if that means filling the gap with an annuity, then that's what we need to look at. We're going to talk about something called reliance rates. So the reliance rates is the gap. How much of that gap money are we needing to pull from our portfolio? Okay? So let me give you an example of that. If our our needs and our wants are $50,000, okay? And our pension is pension and Social Security, all our income is $25,000. Our gap is $25,000. You guys following me? That's easy math. So that $25,000 we're relying on our portfolio to generate. Okay? So what we're looking at is if we're drawing $25,000 out and we have $500,000, we're relying on a higher rate than if our portfolio was $2 million. So the higher you rely on that portfolio, the more nerve-wracking it can get. And that's where sometimes an annuity makes sense, so that you don't have to rely on that portfolio for such a large portion of income. And I'm going to share an example of that. There's different types of annuities. And this is the biggest question I get is people will say, Danielle, are annuities good or bad? And I said, it's like anything though. Cars, they're good or bad. A convertible is good in the sunny weather, but it's bad in the rain. You know, an SUV is good for safety, but it's bad on gas. There's all sorts of cars. It's not annuities are good or bad, they're a tool. Do you need that tool? And how much of it do you need? Okay, so annuities, there's what we call deferred annuities, and there's immediate annuities. So the immediate annuities are kind of like creating your own pension. You give the insurance company a lump sum of money, and they pay you out for the rest of your life. The deferred annuities are you put it in a little wrapper, it's invested, so you have investments, and then you're either guaranteed a withdrawal rate or you just withdraw on your own. There's two different ways to do it. There's many ways to do it. So the example I was going to give is, I've been doing this for a long time. One of my first clients, I could count, I had less than 5 clients at that point in 2000 when I started. She was one of my first clients. Her husband was a great guy. He ended up passing away in 2007. She's still around and she's still a client of mine. But 2008, 2009 were rough on her. She's a little bit older, and we had a good investment portfolio for a year, and she still did good afterwards. But afterwards she said, you know what, Danielle, I'm on my own. I'm needing this money. It's too much for me to take this market risk as much as I was before. So because she was older, we were able to take a portion of her portfolio and purchase an immediate annuity, because the older you are on those, the better they pay out. And that supplemented a good portion of the gap. And it still left her some income that she could use if the roof needed redoing or some remodeling needed up, or she wanted to golf, because she still was golfing. Okay? So there's different ways to look at that and see if you need to create an income stream. All right, so if you have your personal savings, here's some of the things that you're going to need to look at. If it's an IRA, you're going to need to look at required minimum distributions. And I am telling you that the way we look at required minimum distributions are now going to change a little bit with this new Secure Act. We also want to look at our investment and asset allocation strategy. So how much do we put in bonds? How much do we put in equities? How much do we have in cash for emergency needs? Then within that, we still want to look at, out of our bonds, how much do we want to put in longer term bonds, middle term, shorter term, international bonds, real estate, convertibles? How much of the equities do we want to put in international, global, large cap, small cap, mid cap? How much do we want to put in what we call consumer discretionary, or healthcare companies, or financial companies? And then in that, if we want financial companies, how do we determine which financial companies are the best? There's a lot. I hear people tell me, oh, Danielle, I've heard 60-40. And I say yes and no. 60-40 what? That's what I've been told I'm supposed to have. Okay, that goes back to 60 to 90%. Okay, 60-40 may be enough, it may not be enough. So how we get into asset allocation, how do we determine what asset allocation should I have? What do you guys think? All right, so here's what we want to look at. Number one, we want to make sure that we're keeping up with inflation. We want to make sure that the savings will last as long as we need. So here's where I kind of start with the end. So let me go back to my GPS example. You tell me you want to drive to Texas, a little bit further than San Diego. Okay, so now we look at Texas and we start, okay, how long does it normally take to get there if we're driving the speed limit? How much do we want to cushion for traffic delays? How much do we want to sleep? Do we want to drive there in one go? So we start with, what do we need? $50,000 a year, Danielle. Okay, what do we have? So you've got, following me? Where are we? What do we have? I have $2 million. Okay, now let's look at that. That looks like you can get there in the time that you want. To get that $50,000 a year, I'm just throwing a number out there, you would need to earn at least, let's say, 3.5%. Or you would need to earn, let's say you didn't have 2 million, you have less. Then I look at, okay, you need to earn 9%. That's when I say, no, it's not doable. We're not getting to Texas in 3 hours. So we start with where we're trying to go, what we have, and we figure out what our need to earn is. So hopefully it comes out in a decent range, 4 to 7%. So then what I look at is, okay, let's say it's 6. 6% will get you all the goals that you want, all your wants. So if 6% will get you there, and we leave, I'm going to go back to Texas, we leave in enough time, and I tell you, you drive 65 miles an hour and you will get there in time, we are good. Why would you drive 90? Why would you drive 95? Because what happens when you drive too fast is you either get a ticket, or worse, you get in an accident that you can't recover from. Okay, so that is one of the biggest mistakes that I see with people in retirement, is that they still take the same amount of risk that they did when they were 30 or 40. We've got to figure out what amount do we need to take, and then why are we taking more than that? Now, let's say that we said it's 6%, and you're like, oh, Danielle, but I can't see my account go down at all. I can't stomach market volatility. I can't stomach market risk. So then I'll say, okay, I can help with a couple of things. I can help with education, because I think once we understand what really risk is, maybe we can stomach a little bit more risk than we thought. But if you can't take enough risk to get 6%, and that's what you needed to do, then we need to adjust our goals. Maybe you work more in retirement, you retire later, or you don't live off of 50,000. So we've got to figure out what that number is that we're trying to achieve. That's then what gives us the asset allocation. You guys following me? Too many times people just jump into an asset allocation and they say, that's what I was told. What I will say about asset allocation, though, is that yesterday's asset allocation is not today's asset allocation. And let me explain why. If we went back to what I said, 30 years of a bond market, you could have had a bond market, you could have had a bond portfolio that was a heavy bond portfolio, and you would have been okay. You could have been almost 80% at bonds during the last 30 years, and you would have earned a decent return. But if we look at bonds going forward, is about 2 to 3% on average. Now, last year was an anomaly. Bonds returned between 8 and 9%. But on general, we're looking at overall bond returns of 2 to 3%. Equity returns, 8 to 10%. So basically, what it's telling me is if we want a 5%, we have 50% of our portfolio here, so 50%, let's say, is earning 3%, 1.5. 50% is earning 10%, let's say, 5. You add these two, 6.5%. So that's how you get what your return is. That's how you get the asset allocation. And you're like, okay, that's more than that. Or less than that, whatever it is that you're trying to do. But that's how you get the asset allocation. What I think people don't realize is that when you were earning 6% on your bonds and you were earning 10% on your equities, your overall return was a lot higher. So my point is, going forward, overall portfolio returns are going to either be lower, or you've got to allocate more to equities. So in terms of that 60-40, what that really looks like today to get that same return that we used to get with a 60-40 is more like a 75-25. 75% in equities, a 25 gets you today what 60-40 got. Does that make sense? Okay. 75% to equities also means what? A lot of volatility. So that's the other thing. We've got to minimize volatility. Volatility is your friend when you're working and saving. Because if you're putting money into your 401k every month, like you should, and the market's going down, what are you doing as the market goes down? Buying more shares at a cheaper price. So volatility is good when you're working. But when you're retired and drawing income, we need to squash the volatility. If you're pulling out $2,000 a month, we don't want it to be all over the place. We want to keep it as steady as possible. Okay? So that's important. Provides ongoing income, minimizes volatility. Intermediate income versus long-term returns. So people will look at yield. This is yielding, 4%. That's great. What's its growth potential? So again, I'm not saying that it's good or bad. It's just we got to look at the whole picture. Long-term return versus immediate income. All right. Here's some of the tools that are in your investment portfolio, the toolkit: bonds, dividend-paying stocks, CDs, maybe looking at some TIPS, Treasury inflation protected securities. Basically, I'm a big fan of dividends. I used to like to say the dividend today is like a dollar today. You can do one of two things. I'd rather have a dollar today than the promise of a dollar tomorrow, because I can either spend that dollar or do what with it? Reinvest it. And especially as markets go down, those dividends are reinvesting and buying more shares. So during downturns, one of the biggest things that I tell people to help is stop looking at the dollar value. It just gets you depressed. Instead, look at the shares on your account. And if you really did, I have people bring out their statements and they'll look from the beginning of 2008 to the end of 2009, and you'd be amazed at how many more shares you accumulated at a cheaper price. So dividends can help do that. Annuities, we already kind of went through. Basically, the main thing with an annuity is it's a contract between you and an insurance company. That's the main thing to realize. A lot of annuity companies will sell like, oh, we're a very strong insurance company. Most of them are. It's usually not the strength of the insurance company that I'm worried about on annuities. It's the costs. So don't let them oversell you on its AAA rated strength and A+1. And yeah, they should all be strong. I mean, bottom line, I always say at the end of the world, there's going to be insurance companies and cockroaches crawling around on their bellies. Okay, they know how to run the actuary numbers. So looking at costs, and they can provide an income stream for life. Fixed income usually means a little bit less flexibility. So there's a lot of annuities that have what we call income riders on them. Most of the time, after maybe a couple of years of initial increases, you're not getting increases anymore. So you really have to think of it as more like a fixed account. Bottom line, they can be a partial solution, but they're not right for everyone. This is another key word. So what was the first thing that I said? If you don't remember anything else, I think you've already forgot it. What did I say to remember? All right, double checking. Here's the other word that I want you to remember. Sum. What do I mean by that? Anytime anybody says all of your money, you need to run the other way. All of your money. No, some. So let me give you another example. I go to the doctor in 2008 to my general practitioner, 2009, somewhere we're in there. Get all the tests run, my blood pressure's low, everything's good. So my doctor, who I've been seeing for a long time, he says, "You're great." He goes, "You must have a low stress job." I kind of chuckle, all right? So imagine I'm sitting on the doctor, I'm, no clothes on, the white little sheet there. And I'm like, "Well, actually, I'm a financial advisor." And he goes, "Really? Oh, let me talk to you." And he sits down and, "Can I ask you a few questions?" I'm like, "I'd prefer it if I was stressed, but sure, go ahead." Anyways, he goes to tell me that he's nervous, his account's at the bank, and that the guy there wanted him to put all of his money into an annuity. And I told him exactly what I said right now. I said, anytime anybody's recommending you put all of it into something, it's usually not a good idea. I don't know your situation. I'd be more than willing to help. Let's set up a time when I'm dressed. And he did. He came in on a Saturday and he became a client. So the one thing that I always tell people is, if you only have a hammer in your toolkit, everything looks like a nail. So you need to be aware of who's telling you this information. All right, the next thing we look at is what's called a withdrawal rate. So the rule of thumb there is 4 to 5%, right? Rule of thumb. It depends, okay? It depends on what your asset allocation is. Because if you have everything in CDs or low interest bearing and you're only earning 2% on your account and you're withdrawing 4 to 5 because that was the rule of thumb you were taught, your money's going down. Or if you retire at 75 and you're only withdrawing 4% out because that's what you were told, you're not living life as well as you could. That's why I'm not a big fan of rule of thumbs. So here's what I look at. Here's our choices. When we work together, you have this sum of money that you spent your whole life savings. I usually ask, what is the main goal of the money? And I know that may sound like silly, but there's a lot of different goals. I have people that say, I want to spend every last dime. I want to have one foot in the grave and be, my last dollar in my hand. I have other people that say, I just want to kind of live off my dividends and interest and kind of keep the account steady. Or I have other people that say, I want to leave my kids something. I want to leave this charity something. There's something that's sacred to them. I had a lady that, and this is just really random and it's emotional and money is emotional, but her mom left her $400,000 when her mom passed away. So she had in her head she was going to leave each of her kids $400,000. That's what she wanted to do. Okay. So here to do that is what you can spend. Here's what we can earn. If this all makes sense to you, it works. So withdrawal rates, 4 to 5%, rule of thumb, but really it depends. What I look at is that, what I call that line. So if our goal is to keep it steady, is that line being steadied? If your goal is to leave money to your kids, are we on track for that goal? If you were to pass away at 90, do we have that 400,000? Or are we going down like you said you wanted to do? Now, here's the one thing that I've learned over the years is I have some people that will say, I want to spend every last penny. The reality is, as you get older and more unknown things come, most people don't want to spend every last penny. So that's where we work with, okay, maybe we don't want to spend it all, but if we have $1 million, we don't want to leave $1 million to our kids, but maybe let's plan to leave a cushion of 200,000 or something. so that just in case you needed that long-term care the last 2 years of your life, we have that. Does that make sense? So that's really what we're looking at, is what a spending plan can withstand. All right, now's the order of withdrawals. So now we've said, Danielle, 50,000 is my income, 25,000 is coming from Social Security and pensions, 25,000's got to come out of my investments. Where do I pull it from? So we've got 3 buckets of money. That's the goal that everybody should have. 3 buckets of money. The first one is your tax deferred bucket. And that's usually people's biggest. That's because you've been putting in your 401k or your IRAs your whole life. So the tax deferred bucket, bucket number 2, is your taxable bucket. That's money that you've earned at a wage or you've pulled out from your IRA that you've already paid tax on. Anything that money earns, you pay tax on every year. But it's at cap gains rates. And then your third bucket of money is the one we touched on earlier, is what? Tax-free. So the goal in retirement that I see for my clients is to have some money in each of those buckets, because that is now what is called tax diversification. Okay? I have a client that saved very diligently in his 401k, and it's a very large 401k. And we grow it for him. But what happens? He almost gets a little bit mad, because what happens at the end of every year, he gets the new number for his required minimum distribution, the one where the government says you have to pull this out. And he pays a lot in taxes. And so he said, again, Danielle, I could have still saved, but maybe I should have saved some of that, not in my 401k. Maybe I should have saved some of it outside. I wish somebody had told me that. I still would have the same amount of money, or a good portion of money, but not all of it would be subject to that taxes. So where do we take the money from? Again, rule of thumbs, generally take from your taxable, then your tax deferred, and then your tax free. Okay, that's the general rule of thumb. But really it depends on what's going on with you tax-wise this year, what could be going on with you tax-wise next year. Like, we have a client that's selling their house. We knew that. So we're going to be planning for a big tax year this year. So what we did is we took more out of her 401k last year so that she wouldn't have to take out of her 401k as much this year. Do you see what I'm saying? So where you take it from depends. But in general, your tax-free is the most valuable. Okay? All right. Required minimum distributions. Basically at 70.5, which is now changed to 72, we'll talk about that afterwards, is when you have to take that money out. Okay? Roth IRAs don't have required distributions for your life expectancy. So that's something that's really nice. Other sources of income that we want to look at is homes. So are we going to sell the home at some point? Is your goal to pass away living in the home? Do you want to move to an assisted living? So those are questions that we need to look at too. And then life insurance policies. One of the biggest things I think about life insurance policies is just getting them looked at. There's a lot of people that have old life insurance policies that are hanging out, and they might have served a purpose at some point when you had a mortgage and kids, but maybe they don't make sense anymore. Maybe you can turn that into a long-term care policy depending on your health. So just making sure that you're looking at all your assets. So there's 10 themes for 2020 that we're looking at. So 10 areas. The first one is the economy, and all of our little taglines have something to do with 2020 vision. So the economy, we call it keeping a close eye on the economy. So if we look at our expansion that we're in right now, we are in the longest expansion in US history. Over 120 months of expansion. So one of the questions that I get is, Danielle, it has to end at some point, right? Okay, so the one thing that I want to say is expansions don't die of old age. There has to be a trigger. There has to be some reason for the economy to go into recession. The other thing that people fail to look at is just because we as the US are experiencing our longest expansion doesn't mean that hasn't been longer expansions in the world. So this chart here gives you the example of that gold bar is the United States in our current expansion. You'll see to the left of it all the other countries that have experienced longer expansions than ours. And the dark blue means that they're currently in an expansion. So one of the ones that comes to mind is Australia. They're almost 30 years into an expansion. One of the things that we just were looking at with Australia is the central banks have cut rates again. They're doing some stimulus to keep the economy going. They did have one of their slowest growth years last year, but overall it still was positive. Because what is a recession, technically? Does anybody know what a technical recession is? It's 2 back-to-back negative GDP. So we've been kind of what we call a plow horse economy. Those are the words that I've been using. I've been teaching for years here at OLLI, and the word I keep using is we're a plow horse economy, 2 to 3%. Because if we look at the other chart, oh, this slide doesn't have it. See, sorry, there's different charts, but another chart will show that in terms of magnitude, this expansion is actually near the bottom. So when we see a recession, think of it like a V, goes down, and then the magnitude is how quickly that V comes up. Our V is kind of more like an L, but a little bit better than an L. It's more that way. So even though it's long, it hasn't been very strong. Does that make sense? We still think there's a lot more room to grow. The charts they do have here, the one on the right on the top is withholding taxes. So the light blue line is withholding taxes in a rolling year period. It's going what? Up. So what does that mean? If there's more withholding taxes, that means what? More people are making wages. Okay? We already know unemployment's low, but we also know that wage growth is growing. Also, trucking conditions, that's another indicator that we use. They're near record highs. So the economy we want to keep our eye on, but we don't see any near-term recession. It is very rare to have a recession in the fourth year of a presidential cycle, in a presidential election year, because the president usually wants to get reelected and keep the economy going. Where recessions come in is in the year after the election. So we look, 9 of the last 14 recessions have occurred the year after a presidential election. And it's fairly split with whether incumbents or challengers win. So recessions, we need to keep an eye out maybe next year. It doesn't matter the outcome of the election. It's usually just a more risky year for an election. The other reason why we see a little bit of recession possibility next year is last summer, the yield curve inverted. Most people go, what are you talking about? Basically, a yield curve is a normal one. The longer you lend your money out, the more you get paid. If I lend you $1 for a day, you're going to pay me less than if I lend you $1 for 10 years. That's a normal yield curve. An inversion occurs when you get paid less on long term or more on short term. That's the inversion. The reason why that inversion typically can be important is it usually is a precursor to a recession. So remember about last summer, it inverted, and then we had a lot of panic, and then September through December, the market just went down. So it's about a 2-year lead, 22 months before that yield curve inversion, if it does signal a recession, It'll happen. That'll put us about next year at May. Okay? So we'll see, keep our eye on that. 22 months is on average before a recession. The second theme that we have is the central banks, the Fed's corrective surgery. So my personal opinion on this is I think the Fed has done a very good job of navigating to keep the expansion going. They've had to lower rates and raise rates. There's a slide that's not here because it's the smaller slide, but one of the ones that we looked at is the Fed last year cut rates, what we call preemptively 3 times, kind of insurance rate cuts. There's 2 other times in history where the Fed did these insurance rate cuts. In the 90s, and if you guys remember to the 90s, those were the heydays. The 90s were very strong for the economy, and they did rate cuts about 94, okay? So the other 2 times that the Fed did these preemptive rate cuts, it staved off a recession. They did them last year. We're still not in recession, so that's looking good. The other thing is inflation is still very low. So we just talked about the 2 little devils, taxes and inflation. Well, inflation is still very low. And we're looking at inflation to kind of decelerate in 2020. So if inflation is tame, the Fed doesn't have to raise rates as quickly. Growth, that middle chart is showing that growth of the US economy is still positive. You can see 2009, the big dip down. So our economy is still positive, but it's a little sluggish. That's what we said, it's just a little slow. So there's still room for the economy to grow. And then the last chart is the Fed, the last thing the Fed wants to do, because the Fed is an impartial body, is raise rates too soon and then cause a recession in a presidential election year. So we think that most likely the Fed is going to do nothing, or at the very least, possibly lower rates a little bit. But our base case is that rates will be flat. We call it lower for longer. Okay, rates will be lower for longer. All right, number 3, we're in the middle of a political election year. I will say this right now. I am politically Switzerland. Okay? I am not paid to have an opinion on politics. But what I do is I look at it and see how it can affect the economy, because that's what I'm concerned about. So definitely tunnel vision this year. There's going to be a lot of focus on the election. We look at some key indicators. The approval rating overall of Trump is relatively low, but we look at where Obama was at the same time. It was relatively low. I'll tell you there's a few key indicators. The economy is a strong indicator. Right now, 73% are approving of the economy. The economy is usually keeps incumbents reelected. But the 2 key indicators I will tell you that we would look at to see what the election can turn out to, it's unemployment and the economy. So with unemployment, what we look at is about a year prior. So November of 2019, unemployment was 3.6%. If going into the election, because as voters, we vote with our near-term tunnel vision, unemployment is the same or lower, the incumbent usually gets reelected. If unemployment goes up, and not surprisingly, the more it goes up, the more likely they are not to get reelected. So what this is showing is that if unemployment's 3.6 and it increases by 1.5% to 5%, it is a very low chance of the incumbent being reelected. Okay, so unemployment's a big thing. The other one is the economy and the stock market. So basically, overall, if the stock market and the economy is doing good, it generally bodes well for the person that's already in office. But really what we look at is the last 3 months leading up to the election. So the last 3 months, if the market is still positive, there's a good chance that the person will get reelected. If it turns negative, and if it's 100%, it depends on that 3 month, it's 100% almost of past performance. It's not predicting what will definitely happen. But bottom line is, if the economy is positive 3 months in, the incumbent will get elected. That's not taking into account all the ways that you get the votes and and all that. This is just a real short. But bottom line is, we care about our wages and we care about our investments. I'm going to skip this one and we're going to go to fixed income a little bit, because this is important. This is one of the biggest things that I think people going forward need to look at. I hear it all the time. Danielle, I had a bond portfolio. I had individual bonds. They were laddered out 30 years and I was earning 6, 7, 8% on my bond portfolio. And my only thing that I can say is, good job for you, but that's not what the next 30 years are going to look like. There's a couple of things that are coming into play with fixed income. And the tagline here is looking through the magnifying glass, because you really do have to look through the magnifying glass to see how much interest you're getting on some things. So rates are going to be lower for longer. Couple of things. Negative yielding global debt. Has anybody heard of that, negative interest rates? Okay. I was just listening on the way in, so I haven't read the whole thing, but one of my economists that I listened to on a podcast was just talking about how the central banks in Davos met, and they're really against negative rates. So negative rates, think about that. You're paying to have somebody hold your money. We think our rates are low, 1 at 2% on a CD, but think about that. If you're living overseas and we're the United States, a very strong country, that I'm getting 1 to 2% instead of negative. So there is a huge foreign demand for our government bonds. So that's one of the reasons why rates will stay low. The other thing is inflation is low. The other one is the top one on the right. That's a big one. The government has debt. They have to pay that interest, okay? So if you look at that ladder, I joke a little bit, but I'm not joking. I'm like, who designed that ladder? Do you see how much is coming due in the next 4 years for the government? 10 trillion of U.S. debt, over 60% of the U.S. marketable debt is coming due in the next 4 years. And if rates go up, what does that mean? They have to pay more to keep that debt on the books. So that's a very strong reason that in the foreseeable future, rates will stay low. Then the last one is demographics. That light blue line is population above age 65. I just told you I had 2 clients that are now 100. We're getting older. More and more people are getting older. Birth rates are declining. As we get older and retire, what do we usually want more of? Guaranteed bonds, fixed income, yeah. So all those reasons are why I think rates are going to be lower for longer. And that's why we're going to be staying in the 2 to 3% range. I didn't really say this in the last class, but I didn't get into the asset allocation enough. But basically, the reason I tell people bonds are there not to make you rich. They're there to keep you from being poor. Okay? So think of bonds like your airbag in your car. It costs you money to have that airbag. You may never need that airbag, but when you get in an accident, you're sure glad you have that airbag. So bonds are there to protect your portfolio from downturns in the market. One of the key things with asset allocation is rebalancing. So I'm going to go to an easy asset allocation of 50-50 to keep the math simple. 50 of your portfolios in equities, 50% in bonds. The stock market goes down. I don't like the word crash. It goes down. And it goes down significantly, let's say by half. So half of your portfolio is down by half. You following me? And this half, it doesn't go up by the same amount, but it goes up a little bit. So you're still down. So if the stock market went down 50%, you might be down 25%, but this might go up a little, so you might be down 20%. Okay? It still hurts. If you have $1 million, let's think about that. That's now $800,000. So you really need to think about that. But what just happened to your asset allocation? You're now 75% in bonds and 25% in equities. And when the stock market recovers, you don't have enough ammunition in here to recover. You have to rebalance. You have to buy low, sell high, or in other words, sell high to buy low. That is probably the third word of wisdom that I would give you today. Taxes and inflation, never all, use the word some, and rebalancing. Okay, so that's bonds. Now let's look at equities, looking at the bigger picture for equities. Equities had a very strong year last year, okay? Why did equities do so well last year? Well, a couple of reasons. In general, the reason why the stock market goes up is because the stock market is comprised of companies, and those companies make profits, okay? Earnings. Earnings are the magnet that draw stock prices higher, okay? Think about that. Earnings are the magnet that draw stock prices higher. So as stock prices go up, earnings go up with it. They don't always go in tandem though, but in general, they go along the same line. In between is volatility. So the example I like to give is a little boy or girl walking up a mountain with a yo-yo in their hand. And the media is always on the yo-yo. The market's up, the market's down, the market's up, the market's down. I tell you, it's like a tennis match. Boom, 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 boom. In fact, if we looked at the number of days, so we're not talking about how much, and so the number of days in a general year that the market is up versus the market's down, it's a little bit more than 50-50. It's like 53%. 53 up, down, up, down, up, down. It'll drive you crazy. What happens though is people don't realize that as the yo-yo is going up and down, what's the little boy or girl doing? Walking up the mountain. Okay, so that's what I tell people to keep track of on equities. We want to look at earnings. We don't want to focus on the day-to-day minutia. I have people that, why? I don't know, but they will track their investments every day. It's unnecessary and it gives yourself a headache. Okay? People say, oh, I like it. Okay. But let's look at 2018 here. 2018, let's go back to, 2018. So the light blue is your, what we call earnings. The dark blue is your PE. And that little orange triangle, and I can get you these slides too, that little orange triangle is where the market ended. Okay? So bottom line, if we look at 2018, you'll see there was strong earnings, that light blue. I remember giving a talk like this to my clients, and we were saying earnings in the equity market was over 20%. So we had some of the strongest earnings ever. Yet the stock market did what in 2018? Nothing. Nothing. In fact, what we call the PE expansion was negative. So then we go now to 2019, and the dark blue is the most of the return of the stock market, and the light blue is earnings. So actually last year in 2019, corporate earnings weren't as strong as they were the previous year. Yet the market was up 30% versus 2018. But see, what happens is even though they don't move in tandem, eventually they do. It's a magnet. Just think of it. It's always going to draw it up higher. So going forward then, because that PE expansion's already been taken care of, we think 2020 is going to have to be driven by earnings growth. And we do think earnings will be better than they were last year, but it's going to be more muted, because if we're only looking at earnings and we don't have any hot air in our balloon, we're looking at maybe single digits in equity growth. Okay? On average, the equity market has returned 8 to 10% a year. Very few years does it actually fall in that range. It's either up or down, so to get average, you have to give it enough time. All right, record highs. We had 35 record highs notched in 2019. That's a lot. But if you'll look back in the 90s, look at how many times we had record highs. Look at the 2000s. Not a lot of record highs there. It's like a big gap. So I think it's important to learn from history. I'm a big believer in learning from history. 2000 to 2010, we know as the lost decade. The market went nowhere. You're at 11,000, 10 years later, it's still at 11,000. Okay? How did you make money in that decade? Well, you could have. Dividends, interest, bonds, but it really was not a good year for the market per se on market highs. All right, let's look at equity sectors then. And that's looking at double vision of some of our favorite sectors. So everything that you can in the economy is a part of a sector. So some of the ones that we know, consumer discretionary, consumer staples. The difference between those consumer discretionary is I don't really need it, but I have money, so I want to go on a cruise. I want to buy a Coach purse. I want to purchase something. Consumer discretionary is whether the economy is good or bad, we're still brushing our teeth, washing our clothes, you know, that kind of stuff. We've got communication services, industrials, healthcare, financials, technology, materials, utilities, real estate, and consumer staples. So those are our sectors. So the sectors of the economy that we like right now are things that are cyclical. Those are those light, kind of beige colored. We think cyclical companies are going to have the best earnings. And I just said that in 2020, we're all about earnings right now. We look at the defensives. Those are the blue, your real estate, utilities, consumer staples, and healthcare. Still doing okay, but not as strong. So the areas that we like to overweight right now is information technology, and we're going to talk about why. We're going to look at industrials, communications, financials, and healthcare. So those are the areas that we really like right now. Here's one of the biggest mistakes, though, that I see people making with their money. They try to change their portfolio based on who gets elected to office. So we're going to look at two examples. We're going to look at healthcare, and we're going to look at the Clinton era. So healthcare was the #2 performing sector under Clinton. Outperformed despite fears of Clinton's universal health care plan, which was abandoned. And then now let's look at Obama's period of healthcare. Healthcare was the #3 best performing sector, over 20%, outperformed despite the passing of the Affordable Care Act. So I had a lot of people that would say, oh, Danielle, I don't want anything to do with healthcare. There's too much going on with healthcare. They're going to do this, they're going to do that. I want to stay away from healthcare. But the bottom line is, what did we just say next Saturday's talks about? Replacing joints, we're getting older, you know, we need more medical care. And what did I say the other chart was? More and more of us are over 65. So think about that. There's more and more of us over 65, more and more people needing knee replacements, more and more people needing health care, more and more people needing prescriptions because there's more ways to control diseases now. So don't play politics with your portfolio. The other one we'll look at is energy. Energy is typically what we call a Republican kind of sector, that when there's a Republican in, energy usually does well. So we'll look at Bush. Energy was the #1 performing sector under Bush. Energy outperformed as the Iraq War caused oil to rally from $20 a barrel to $140 a barrel. So it wasn't really about policies. It was just a war. And then if we look at even under Trump, so energy has underperformed despite deregulation, record production, and a rise in oil prices. So the main thing I think is to not try to guess what the next person in office will or will not do. Is just look at the economy and figure out, am I going to be buying a new smartphone? Am I going to be needing a new hip? And what's the general demographics out there? One of the biggest things in technology that we're looking at is the 5G network. This, to me, is really going to revolutionize things, both near term and far term. We'll talk about some of the near and far. So some of the near terms, they didn't give me the chart in here, but one of the ones that we looked at with the near term is that the adoption rate of 5G technology in terms of physical hardware and the components of that, Very few people have the hardware to get 5G technology. In the next 5 years, 75% of the population that own a cell phone right now, so we're not trying to get the people that don't have a cell phone, 75% of the population that own a cell phone will get the new 5G technology. That is huge in terms of turnover of phones. This chart talks about all the companies in the different areas of the economy and how they think that 5G will affect them. So we're looking at financial services, media and entertainment, public safety, automotives, healthcare, robotic-assisted surgeries now, robots for manufacturing. I know people will say, oh, yeah, but we don't want that because we're taking away jobs. Do you know that there was a job once upon a time that their job was to light the gas lamps on the streets? That job is gone now. Do you know there was also a job to drive the horse and buggies? They didn't think a machine could drive, that you had to have a person that would drive the horse and buggies around town. I don't know about you, but I haven't seen on LinkedIn horse and buggy driver. My point of that is certain jobs do go away. That's the evolution. And certain jobs get created. So as long as we're an economy that is taking advantage of the technology to create more jobs and do jobs efficiently, that's a good thing. Why do you think companies have become so profitable? Why do you think we're in one of the largest expansions ever? And I'll tell you, that's not just from this president, that's not even from the president before. We're talking probably from the mid-2000s, late 2000s is where we started this expansion. Profitability. Things that took 5 people to do, now take 3. Things that took 3 people to do, take 1. Things that used to take 1 person to do, you can now do on your app. How many of you guys remember once upon a time traveling and you would actually walk into a physical ticket office to buy that travel ticket? You had to walk in, speak with a person, purchase a ticket, paper ticket. You lost that ticket, that was money. How many of you guys have booked a travel on your app phone now? So who's doing the work? The company, Delta, or you? You. And they designed the app, but apps and apps are getting cheaper and cheaper. So think about the efficiencies now that companies are doing with these apps, and that they can do it faster. Just to give you an example of what 5G means in terms of speed, if you looked at 1G, 2G, even 3G, you can't download a TV show. If you wanted to download a TV show, and I do remember this way back when, I was flying on a flight and I'm trying to download some movie to my phone so that I could watch it, and it's taking forever and ever and ever and ever to download the thing, you know, and then once I had it downloaded, then I couldn't do anything else because I ran out of space. There's no cloud to, you know what I mean? It was just, it's crazy. If you think of 4G, which most of us are operating right now, you can download 1 television episode in less than a minute. You can download your favorite episode of Friends in a minute. 5G, you can download the entire season in 1 minute. That is the difference in speed. So international, blurred vision for international equities. So one of the things about international is, this is what I taught the other day in my class to my clients, is that we've got to start thinking differently about international, just like we think differently now about apps and technology. So we used to think about international as US, and then everything else was international. Well, those were the days when, yeah, a company in Korea or Germany only sold to those people. We've got to think globally now, because it's less and less important where a country is domiciled as to who do they sell to. So think about this. I got a lemonade stand. I'm standing at the corner of my street with my lemonade stand. Who am I selling to? My neighbors. I then get the lemonade into a grocery store. So now who am I selling to? To more and more people. Well, now I get that lemonade to be served in restaurants and all throughout the world. I have famous lemonade. Do you guys see what I'm saying? Like, the more people we sell to, that's a global company. I went from but I'm here in California, or I could be somewhere else. So the way we think about international and US has to change. If we think about it traditionally, international has underperformed US companies out of the last 8 of the last 10 years. So when you hear that statistic, you think, well, why am I not only buying US? The S&P 500, that's all US. Because the US is only 25% of the world economy. 75% of global companies are domiciled somewhere else. So why, if you're fishing, why would you only fish in 1/4 of the pool? Okay? So you've got to add international. Yet I have people, oh, Danielle, but the US is so strong, I don't want boring international. No, we don't want boring international either. We want good global. Okay? And we want good global companies. Because even though the US has outperformed, the top 3 performing companies last year were all international. In fact, the largest, and I don't remember how to say the name, and I know I'm going to flub it, but it's something like Kawaii Matao, and it's a Chinese company. They are now the #1 distiller of booze in the world, outpacing Diageo, which Diageo, some of you might know some of their brands like Seagram's. So this random Chinese company is now the biggest alcohol producer, and their stock price more than doubled in 2019. So my point is, don't listen to the headlines of international. You need to make sure that you have a diversified portfolio of global companies. The other reason why I still like dividends, or I still like some international companies, is if we look at dividends, the US dividend, average dividend is about 2%. So the US company pays an average of about 2%. An international, we're talking Europe, developed market company, pays an average of 3.5%. So if I'm retired and my bond yields are really low, that can help me get some yield in my portfolio. So there's a lot of reasons to not count out international. That bottom chart on the right is just showing that people aren't putting money in international. They're putting money where? In the S&P 500 index. And that index, when the market corrects, is going to go down 50%. Okay? All right. Blurred vision for internationals. We're also going to look at emerging markets. So emerging markets is generally an area that most retirees stay away from. And that's okay. I always tell people it's like a cherry on your sundae. You can have a perfectly good hot fudge sundae without the cherry on top. Okay? But if it makes sense to you, you might want to look at emerging equities. The reason being, there's 2 reasons. One is 60% concentration in emerging markets in the overweight sectors. So emerging market companies are tending to be technology, healthcare, financials. So you can double dip. You can get the favored sectors and a little bit of the emerging markets. And if we look at those orange bars, it's showing that the pricing is looking good, that they're set to rebound, and it's at a favorable valuation. But here's usually what I say with that. Although a cherry on top of the sundae is beautiful, you don't want a whole bowl of cherries. So people tend to do too much. We go back to that all. So we're going to do just some, just little sum. So the sum, I usually say, is no more than 5%. No more than 5% of your equities should be put towards emerging markets. Okay? If it makes sense at all. I'm going to just hit the dollar really quick. The dollar has been very strong. We think the dollar is going to weaken a little bit. That'll also make international investments a little bit more desirable. A couple of reasons, the deficits. We look at the trade deficit. We look at the fiscal deficit, keeping the dollar low. So we don't really see the dollar kind of going strong anymore. Oil also we see rebounding a little bit. So a little bit of the energy companies coming back. We're looking at maybe $65 a barrel on oil. So just the dollar weakening a little bit. Usually when the dollar goes down, the areas or weakens, the areas that we see it is on emerging markets, your bonds, and then commodities. I'm not a big fan of gold when we look at commodities. I'll just tell you why. I mean, commodities to me are very volatile. So I usually try to stay away from them, and especially gold. The one thing I don't like about gold is gold does not pay a dividend. So gold is a hedge. Gold is a risk hedge. People will run to gold when they're fearful, and they run away from gold when they're more confident. I like things that pay dividends. So to me, the fearful, if you want an asset class that will help you when you're fearful, it's bonds, okay? Bonds will get you through it all. Let's go to market volatility. Volatility is hiding in plain sight. If we look at performance and pullbacks, you'll see 2019, we had the biggest, this is telling the sector dispersion, so the chart's not there with the pullbacks. So we had an average of 5% pullbacks in 2019. We had 2, not on average, I'm sorry, we had 2, let me correct that. On average, we should experience 5% pullbacks a year. In general, we experience 1 correction of at least 10% or more a year. The average correction is 14%. What that means, what I tell people, is from some point, from some statement to another point, when you got another statement, the market was down 14%. That usually happens once a year. We did not get that last year. Now let's go back to 2017. We did not get that in 2017. In fact, in 2017, it was an anomaly because every single month the market went up. It had never happened before in the history. So again, I get a little concerned at that because people then forget volatility. So let me share the story of what happened just when I did this longer talk at my office. One of my clients came in, we had a lot of people coming in. She says, Danielle, I want to talk to you. I want to take more risk in my portfolio. I said, that's exactly what I get concerned about. It's because people did good and they get greedy, like they want more and more. And it's like, we've got you on the right risk. And people forget that markets can go down just as fast as they go up. So volatility, definitely in an election year, because there's a lot of mudslinging, okay? And people will say, oh, this is the ugliest election. No, I'll tell you, every election is ugly. You can go back through all of history and every election. I mean, there was one election where they pulled the guns out in front of the White House. So basically an election year in general is more volatility, okay? We think that we'll get closer to that 4 or 5% drops. And what just happened just the other day, I did this talk on Wednesday and I mentioned it. I said, the things that cause a drop come out of the blue. What just happened that caused the market to start going down? Coronavirus. Now, did anybody know that 2 weeks ago? Nope. You don't plan for them. That's why they just come out. So here's the key themes. We think the economy is going to keep growing along at maybe 1 to 2%. Still nothing too good, but or too great, but not too bad. Not too hot, not too cold, Goldilocks. We think the bond market, you're still going to stay low, probably 2 to 3%. The yield on the 10-year Treasury, maybe 1.75. We think equities will be slightly positive, but in the narrow single digits. The dollar will reverse and weaken. Oil will come up a little bit and definitely increase volatility. So that's kind of what we see on our outlook for the next year or so. But with having said that, what I tell people is we invest not just for the year. Yeah, we look at some of the sectors and we look at the economy and we look at all those things, but we invest for the long term. So I've had people, well, Danielle, what is the long term? I don't even buy green bananas anymore. I don't know what long term means. I don't know what long-term is either. But to me, my long-term's as long as you're living and you're my client. And that can be 5 years, 20 years, I don't know. But that's what we're investing for. And then at some point, when you're not here, we're investing for someone else, whether that's your kids, your spouse, your charity, or the government. The SECURE Act, it was passed in December 2019. It's called Setting Every Community Up for Retirement Enhancement, hence the name SECURE. I love the name. It's like, it's all in the name, right? We're setting every community up for retirement enhancement. So 11 things got passed through. The back side of this shows the main implications for business owners, and 401ks also got a lot of changes. So I'm not going to hit on the business owner ones. The main one I think there that we can talk about is the increased annuity options inside retirement plans. So before, and I will tell you this, I've been doing this 20 years, things change. Because if somebody had an IRA that they'd rolled over from their 401k, and then as a financial planner, with what we just said, I said some of that money should be in an annuity, the government threw their hands up and said that's wrong. Because annuities are tax deferred, and so is your IRA, it's tax deferred. And I used to say it's like opening an umbrella inside the house when it's raining inside. You don't need double tax deferral. But we're not purchasing the annuity for tax deferral, we're purchasing the annuity for lifetime income, and that's what matters. So now the government not only sees that that's good, they're actually making the laws so that you can purchase an annuity inside your 401k now. Here's my concerns. I've just started looking into this. There's still a lot to learn about it, but the types of annuities that they're allowing are the immediate annuities. So think about this. If somebody's 58, 59, 60, even 62, what they're saying is if you have $1 million in this 401k, you can convert that into lifetime income, just throwing a number out there of, let's say, $2,000 a month. So the person who's 60 years old says, well, that's good. I got Social Security, I got this now, and I'm all set. And they don't understand taxes and inflation and all of that. And they now have used all of their 401k money to purchase this annuity. And remember, those annuities, the younger you are, the less you get paid. And it's irreversible. That's my main concern, is really educating people. Part of how the government tried to educate people or keep people, because remember, pensions are going away, so we're relying on our own savings, is they started putting target retirement date funds inside of 401ks. So now a lot of the plans, so it made it easy. If I'm going to retire in 2040, I just pick the fund that says 2040 and I'm good. Those didn't work good enough, so now that they're putting the annuities in there. So that's one of my concerns. I still need to see, are they going to allow partial annuities, and how are they going to educate the person on what makes sense? And, you know, I honestly think planning is going to become more and more important. So that is that one. The two ones on the front that make the most sense for retirees, or not make the most sense, that affect the most retirees, is the removal of the stretch IRA provision. So let me explain the way it used to work, and then let me explain the way it's going to work. So it used to work that if you had an IRA in your name and you passed away, you would leave that IRA to your spouse, and the spouse had a couple options. They could keep the IRA in your name, depending on age, would depend on whether we did or not, or they could roll it over into their own name and take it as theirs. That still stays the same. It's when the IRA then gets thrown down to the next generation. So there used to be something called a stretch IRA. If I had my IRA, I had no spouse, and I passed away, I named my kids as the beneficiary, they would recalculate the required minimum distribution that they had to take out based on their life expectancy, and they would continue that for as long as they lived. And if they passed away before their life expectancy, they could name another beneficiary, their kid, my grandkid, and they could continue stretching it out over 30 years. Now, this is changing. You have to take the money out within 10 years if you're a non-spouse beneficiary. The change is you don't have to take something out every year. That was required before. You had to take a minimum required distribution every year. Now, between year 0, the date of death, and year 10, you can take it all, you can take some, you can take none. They don't care, but by year 10, that account needs to be cleaned out. So a couple of big mistakes that people can make there is if they leave it to their kids, the kids say, hey, it's $1 million. I'm going to leave it there and let it grow. Year 10, it's $1.5 million. Ooh, I didn't realize this. You have to take it out. What does that $1.5 million just become? Income. So you're looking at maybe in today's rates 50%. But what if taxes go higher? And there was a point in history where the highest tax brackets were paying 50, 60, 70, 80, 90% taxes. When you go back to the 60s, the highest tax brackets. So what if 90% of that $1.5 million is taxed? So that's what you have to think about. It's a big deal. Many times people won't convert their IRA to a Roth IRA because they don't want to pay the taxes. I get that. If you convert $100,000 today out of your IRA, you pay the tax on it. If you're in the 25% tax bracket, $75,000 goes into your Roth, really the whole thing, but you have to pay $25,000 somewhere to taxes. But think about if your kids inherit that money and they're in their prime income and you leave them $1 million, even if they take it over the 10 years, 100,000 divided by 10, they just try to stretch it out a little bit through that 10 years, you're still adding $100,000 to their income in their prime life. The required minimum distribution was a lot lower, so they could take the lower amount, and by the time your child retired, they could take a lot more, but it was okay because that replaced their income. That was how it used to work. This changes that whole dynamic. So it really is something to think about. I just want to give food for thought that I think you need to think about. Does converting to a Roth IRA make sense? What's my goals with this IRA money? Am I spending it? Am I leaving it? Am I charitably inclined? If you're charitably inclined, you know, I know people that'll say half my money is going to a charity, half can go to the kids. They're not getting all of it. Well, what half do we leave to charity? We really want to leave IRA money to charity then. You know, so we want to be looking at that because your taxable account at the date of death gets a step up where the kids will have to clean out the IRA in 10 years. So there's just a lot going on there. The second thing on the Secure Act that it did is it pushed back the required minimum distribution age. There's many people that I asked, if the government didn't make you take this money out of your IRA, would you? No, but I have to. And you have to because it's a 50% penalty if you mess it up. 50, the stiffest penalty in the book. Okay? So 50% penalty if you mess it up. 70.5 is when it used to have to start. If you are already taking required distributions, because you turned 70.5 last year, you just stay doing what you're doing. If you were turning 70.5 this year to 2020, you play by the new rules. You don't have to take it till 72, okay? But again, I think what that's going to give people is the option to maybe I want to take some money out of my 401k and convert it before I have to take those required distributions. Because the thing about converting your IRA from the Roth is if you're taking required minimum distributions, you have to take that money out first, pay tax on it, and sit it in a taxable account, and then you can take some amount out of your IRA and convert it. So there's a lot going on with the tax laws. It's not just, I tell people, financial planning, wealth management, it's not just how much should I have in stocks and how much should I have in bonds. There is a lot more to how much can I take out, how much can I sustain, where should I take it out, what are current tax laws, what if tax laws go up, what happens about estate planning, what's the best way to leave my money to where I want it to go. So there's a lot of things that you can do. Especially even now with the way that the standard deduction has changed. You know, it's a higher standard deduction. So we used to have a lot of clients that were itemizing, and they're not itemizing anymore. So they're taking the standard deduction, but if you take the standard deduction, what don't you get to write off anymore? Charitable contributions, right? So I have people writing checks to charity still. I tell people writing a check to a charity is the worst way to give to the charity. I mean, if you want to write a $25 check for the local soccer team, that's fine, but I'm talking big charitable donations. So churches, institutions, universities, big charitable names, you can donate either appreciated stock or you can donate directly from your IRA through a qualified charitable distribution so that it doesn't become income and then you still get the deduction for it, or you still get the benefit from it. So there's just ways to think about charities. Appreciated stock is a big one. So I had a client, he worked for a company. Because he worked for the company, he had a large chunk of that stock, that company stock. He liked it. I get it. You know them, you've worked for them, you like it. But it's still a lot. And it had a low cost basis. Right? So I suggested donating some of that stock to charity. Yeah, I like it. I told you I like it. I don't want to get rid of my blah, blah, blah. Okay? That's okay. Donate it. What were you going to donate before? Oh, the cash in my bank account. Okay, then take the cash in the bank account, buy the stock back at today's price. You still have the same 100,000 in that account, but now that 100,000 has a cost basis of today's price instead of yesterday's price. It's like genius. So I said cash is the worst way to give money. All right, so those are some of the biggest implications of the Secure Act. I think, again, it's very new. It's just like a month old. People are going to keep digesting it. We're going to get more clarity on the annuities that come in the 401ks. We're going to get a lot more clarity on, what the 10-year payout is and what are some options to do that. So we'll keep learning about it. That's pretty much the class.